All right. Let's see. So it is Tuesday, November 29th. I can't believe it's almost December. That just blows my mind. But I appreciate you guys joining. We're going to do something. Usually I do a review around now. We're going to do something just a little bit different today because honestly, the price action was not conducive to finding a whole lot of trades today, in my opinion. There were some, and we're still gonna look at the action, but rather than pointing out like each of let me just erase these extra lines. Rather than pointing out each of the valid setups that I like made decisions on throughout the day, I thought it would be helpful to share what I've been working on for the last week and a half or so. I'm always working on new things, and other members in the trade and perform room are introducing new ideas. And then it reminds me of things I used to do, and then I think, oh, what if I took this other idea that's kind of like that and mixed it together, right? So that's how I usually come up with some of these new ideas. They're new because to everybody, and they're new to me too. But it's primarily just a mix of some of when you've been doing this for long enough, you kind of know what works, and it's just a matter of deciding when to apply what. And so this is a combination of two ideas that I know have worked in the past, but they both work better in slower when price action is relatively slow, and not when it's super volatile and fast. When it's really volatile and fast, you guys, you have to go back to your you need to almost like just get pre-programmed to just like push the button. There's no thinking time, right? You know where you know what you need to see, and you wait, and when you see it, you hit it, and you just do that high odd setup over and over and over again, and you make money all day, right? That's preferable. And this algo, which is actually based on Simon's Trade and Perform algo, here I'll open that up too so you guys can see what the original one looks like. As you can actually find this new setup will work there as well. It's just that we would need to add something, but we could do it on this as well, just for those. If you want, let me know. But I've already got everything set up here, and I only have about an hour, so I was going to do it here. But here, let me just where are we? The open, right? Yeah. Okay. So yeah, these are I'm basically combining. Realize I'm rambling here, but I'm combining two ideas that I've used in the past, but I've never used together, right? And if you guys have been trading for a while, and maybe you've moved on from an old idea that used to work but stopped working, and then since then you've learned new ideas, you may want to go back and look. Well, hey, what if I introduce this new idea with this old idea, and maybe that'll actually work, even though the old idea kind of stopped working. Well, this old concept that I'm talking about is trading with divergence. Divergence is where an oscillator like a MACD or really anything, an RSI, volume zone oscillator, whatever you want, where it is making higher lows, but price is making lower lows. So if we back out a little bit, you'll see it better here. It's a little bit easier to see with more information. So the easiest way, the MACD doesn't move as much, so I'm going to show you it there first. So take a look. If we find the low, so you can see this is all a downtrend, right? Lower lows. So if I find the low of the MACD, what you'll find is that it's actually way back here. It's like that space is so small you can't even see the low. Let me just reset it there. It's like way down there, right? So the low on the MACD happened here, right? And then as price continued to fall, what you see is the MACD made higher and higher and higher lows. See, right? So the MACD is already having this is the MACD histogram. It's just I've just got it. It just looks like a line because I find that easier to see. I don't need as much space. A lot of people use the histogram still, and I just find that a little bit hard. It takes me an extra millisecond or so to interpret what I'm looking at when it looks like bars going in both directions. So this is just this is real obvious to me. That the low was back here, and that the subsequent lows were higher than that initial low. And so, like I said, in the past, when I wasn't trading with leveraged futures, but instead I was trading with options and stocks, and I was swing trading. I used to use stochastic divergence to filter out which trades I wanted to take and which ones I didn't, and it does work. What you have to be careful of with divergence is, first of all, you need to know how to read it, because you can until you really know what you're looking for, it's easy to misinterpret. And then you need to know what conditions that that divergence actually work, and where it's actually not so useful. So the first place where divergence can be useful is when you are going into new lows or new highs, right? It's easier to talk about this from one direction, but realize that like they both, the inverse is also true. The long is often a little bit more consistent, but the short, you just kind of invert it and it still works. So again, a time when you might want to use divergence, and again, you can do this for any oscillator really, is when you're falling on this smaller time frame, but perhaps on a higher time frame, perhaps you weren't doing this, right? Instead, you were, if I back up a bit, we can find a situation where on a slightly higher time frame, it may, here. So this is more of an uptrend, right? See how it's going from the bottom left to the top right? So the big picture, it's an uptrend, but within this uptrend, there's a pullback, okay? And so if, in this case, I don't see divergence, but if there was divergence here, this is the kind of place where you'd want to use it, where you've got, if you have lower lows, but lower lows on price, but higher lows on the oscillators. Let me just see, this one is just so small that I can't see it. Maybe there is divergence here. There is slight divergence on the MACD. So see how these are clearly going lower, and these are not, right? They're either going higher or they're flat, and so that would be MACD divergence. So you don't want to take a trade just because you see it, okay? You're not, I mean, you could, but I wouldn't do it with leveraged futures. You're not going to be right 70% of the time if you just buy every time there's divergence, because sometimes it just diverges over and over and over again, and it every low makes like especially when it's in a downtrend like currently. At the end of today, we saw why you shouldn't be using the strategy alone, and I experienced this as well when I used to try to do this. So here's a good example. So, okay, so there was an impulse up, and then they got trapped, right? All these guys got trapped. So it's bearish on the bigger time frame. Once you get under, why can't I grab this? So you get under this guy, and you develop some volume under there, all these guys are trapped. So you have to know on the higher time frame that it's bearish. But let's say you're scalping and you only look long, right? And so you're like, okay, well, I want to see if there's divergence, and maybe I can buy. And you're probably right. So in this situation, you're putting in some lower lows. The MACD made a lowest low here, right? And then it started to rise, even though price was falling, making a higher low. As a result, trades that set up over here are going to work better long than trades that set up over here, generally. Now, the question is what should your trade trigger, your entry trigger be once you have that divergence identified? Because like I said, in my opinion, buying, like this is the first time we had divergence here, right? Buying this regardless and expecting it to go back to the high is totally unrealistic, because you're actually in a downtrend here, and that's not going to happen. So you either need to have a way to identify where current resistance is, which you certainly can. Like here, it happened to be the previous point of control, which was causing, we got under it and it turned into resistance. So you could have targeted that and been okay, right? So if you have a good target, you can do it. And then the other thing you can do is you can wait for, that you need a good target. Otherwise, you're not going to have risk reward, right? But to help with the risk side, which with where do I put my stop? How much should I risk? When should I get in and stuff like that? all of those important questions that you need to have built into every one of your entries. Uh, for me, I wait for signs of aggression. So, for instance, these stars or the diamonds are good examples of signs of aggression. So, when those happen on a bullish bar, it's a sign of order flow aggression. You could see it on the footprint or on the DOM if you were watching it, but this is the algo is basically just a audit of that DOM movement of all the auction itself. It just shows me like where price went and how aggressive it moved. And so if this target was far enough away from this entry, I might be able to take that trade. But what you can see is if this is the sign of aggression, my stop naturally would have to go below it. That's just the rule. So the stop has to go down here if that's my sign of aggression. And I can't enter until that bar closes. So the lowest, well, the first opportunity to get in would be like 11,692 or so. And then I would have to decide, I could just buy, or I could wait for a little bit of a pullback towards my stop and buy there. Technically, that's okay too, but only after this is closed, because that's when the signal is valid. But then, like I said, before I take the trade, I need to determine whether or not I have good enough risk reward to get to a reasonable target, considering where I have to put my stop. So in this case, my stop, let's say, is like, it's probably like around 75. And my entry is like, let's say 90, just to make the numbers easier, right? So you've got a 15-point stop. And so I would need 05 to get 1-to-1, right? Which is, I would need, let's see, because I'm getting in at 95. So I would need 11,710 to get 1-to-1. And you can see that we clearly have an important resistance point. Like I said, the previous day's point of control is colored blue because it's a really common support and resistance, and it causes a lot of choppy trading. The previous day's VPOC, it's right in the way. So I would not be able to take this trade, even though everything, even though all those conditions set up. It's got divergence. It's got my sign of aggression. The problem is there's resistance in the way, and I'm working against the trend, so I would not expect anything further than this most days. But look what happens. It sets up again. I get an additional sign of aggression, the green colored bar, and we're continuing to divert on, why can't I draw this? On MACD. We're making higher lows while price is making lower highs. Now in this case, my stop goes down here, right? So like at 11,668, let's say, and my entry is at 85. So it's not quite 15 points, but let's just call it 15 points. So that would mean I need to get to 11,700. Well, that's right where my target is, the point of control. So I could take this trade, get 1-to-1, and I'd be out of the trade here unless I wanted to hold runners, but in this case I probably wouldn't. And that's the trade, right? And then whatever it does from there, it doesn't really matter. I would just have to wait for the next entry. And in this case, it chops around the point of control because that's what happens at the point of control. So that's a simple idea in a nutshell of how divergence works, right? I can take the ideas I already had, and of getting into a trade with aggression or a trap, what we call a trap back in, where you have an apex that comes in, and then we trade under it and immediately come back up. In the trading performance, we call that a trap back in. And a way to improve your odds on the trap back in trade is to wait for divergence in an oscillator. So the MACD histogram works really well for this, but you can use honestly any oscillator. And something I was experimenting with was using what's called a volume zone oscillator. This is available on volume zone oscillator is available on Sierra chart. Let's go down to V, and it's right here. Right, and so you can just hit add, and anybody can get it. It's not something unique to us. It's just something. It's just a regular old study, right? And what it does, it's real simple. The basics of it is when we put in a down bar, and therefore volume, assuming it's not divergent, and volume is primarily, well, let me start this over. Okay, it's going to reevaluate what the the value of the indicator is going to be evaluated only at the close. That's when it matters. You're going to see, if it's live, you're going to see it moving around. None of those little movements matters till the Renko bar closes. It's very important. You need a closed bar to read this indicator. Once the bar is closed, what it's doing is it's comparing the buy volume compared to the sell volume. So the volume on that happened when price was getting pushed into the ask, and compared to how much volume was getting pushed into the bid, right? So it's almost like a running delta total, but it's not exactly that because it's re-evaluated every bar. And for the Renko bars, I'm using the 24 tick, but you can use any tick size you want. But what's cool about that is because I'm using it with a Renko chart, what you can see really clearly is when I have like what we call an impulse wave down, right? So this here, impulse wave down. What you're going to see on the indicator, this is the one on the bottom now, right? This is the MACD here. Let me make the MACD smaller because we don't need it so big right now. Let's see here. What happened to my? Can I just? Okay, I'm gonna have to. Well, that's annoying. Where did my volume go? I must have fucked it up. There it is. Okay, good. Like I said, I can mess with that later. But we're just gonna look at the bottom one. And when you have big impulse waves down, where price pushes straight down, we call them impulse waves because there's not really any reactions. It's just either buyers pulling their orders or sellers continuing to sell, right? There's usually when this happens, there's usually aggressive traders up here, and there's usually trapped buyers up here, and then you'll get an impulse wave. And on the impulse waves, what's going to happen is on the indicator, the oscillator, the volume zone oscillator, on these impulse waves, this line, on an impulse wave down, the line is going to go pretty deep, right? And the reason for that is because it's primarily selling volume with very little basically profit taking when it goes flat or slightly flat, followed by continuation of selling, right? All the selling is on the bid, is what this is telling me. Now, there are these lines here. So there's the green shaded area, the midpoint is a dash, and there's only a couple lines you really need to know. I primarily use these to line up to see where we are. The ones that matter are the red lines, the red line down here and the red line up here, and then the second purple one and the second yellow. So these are zones, is the way I think about it. So underneath the green shaded area, down here from the second yellow to the red line, and then anywhere further than that, it can kind of be thought of as like an oversold type situation. I hate that word, and it's not actually what it means, but we're going to use it in a mean reversion way in just a minute. And so I want you to think about it as like if you were looking at RSI and you have your lines drawn at like whatever it is, 30 and 60 or whatever, like this is your lower zone, right? Where and the basic rule when it comes to actually using this for me is I can't buy anything once I've seen this fall down through here. Once we get an impulse wave down started, I can't even think about buying this chart until I get the volume zone oscillator down at least under this yellow line, and then preferably I'd like to see some divergence, which we just talked about. So that divergence can either be on the MACD or on the volume zone oscillator itself. Either one works. The MACD divergence is more accurate, but if you are struggling with buying when the market is selling or selling just as the market is buying, for instance, if you are selling these and then giving up and missing this indicator might help you, because what you can see is the inverse of what I just said, where I'm not buying until I've got divergence following a drop into this lower zone underneath the green shaded area. the exact opposite's also true. So if I'm looking at the opposite side, I don't really want to be a seller until we've gotten up into this upper area and we've gotten divergence. In this case, that happens here is our divergent high. See that, how we made a high here, and then we make another higher high on price, but it's a lower high on the oscillator. Importantly, though, the high before it was above this green shaded area. I don't care really about these divergences, like this. If that's divergent, I don't care about that. Because this is in a neutral zone. And yeah, I could immediately sell it if I thought it was bearish, but generally I'm not even watching this oscillator when it's inside the green area. It's only when it gets outside of it. And I'm thinking about, when do I want to fade this move? Like, I'm getting FOMO about fading it. Well, the rule is you wait for this, and then you wait for this. Right? Once you've seen this, now you can start taking your aggressive shorts. See that? Whereas the exact same aggressive signal showed up here and gave you 2 points. The one that showed up when the volume zone oscillator was divergent here, after getting into this like overbought zone. I'm going to call it that, but that's not really what it is. But that's just that's what something people can understand with, like, what's it called? Mean reverting oscillators. It's similar to an overbought, but that's not actually what's happening. It's just lots and lots and lots of buy volume up here with very little counter here, down here. So here it's getting all the way to the top, and the selling doesn't actually start until here. And that's where everybody thinks they want to short, is they're like, this is overdone, right? Like that. This is where it starts to feel like it should be a short. If you're watching this and you're used to fading, you're naturally going to want to start shorting up here, and it's wrong. It's really wrong. It'll ruin your account if you do it. Shorting's hard. But fading is hard. It's not shorting. It's fading. It's tough, right? And so if you are getting anxious and getting into shorts here, and then you're like, damn, it didn't work, and then you get on the footprint the same exact signal, and rather than getting 2 points, this one gets like, 100. You'll be really pissed off, right? And that's understandable. Well, one way to help keep that from happening is to use something like a volume zone oscillator, because in this case, I'm not interested in fading an impulse move until they've put in so much buy volume and so versus sell volume that they're getting way beyond what would be normal. And not just that, right? You don't sell here. That happened, right? But you don't sell it. You wait until you now have a divergent high. And you're in your whatever your order flow signal is, right? So for me, it's a volume shift down with a momentum shift down, which is what these signals mean here. But like I said, that exact same order flow signal was here. Exactly the same. The orange bar was here too. And that one did not work, right? So if you're just selling orange bars, you're gonna have trouble, right? If all you're doing is looking at this and you're saying, I'm gonna wait till we put in a high and volume shifts down and then I'm gonna sell it, you're gonna get wrecked over and over again, selling this and selling this, right? Like if you know how to read a footprint, you'll see what I'm saying. They're shifting volume down. It's an overbought chart, and it goes higher. See that? But rather than selling these in here, don't do that. Wait until that happens, and then if you get a high that's divergent, and you get the order flow signal that there's shifting volume down, now you can start to fight the trend. Only then, right? And so what that's allowed me to do is I'm now, because the way it used to work is like, it was like 1 for 3. I would like short there, short there. And it was okay because like I would lose 15 points, make 50, right, when it worked. And so I was like, you know what, that's all right. Like I'd make plenty, right? But sometimes it's not the third one, right? Like sometimes it never comes. Sometimes I give up after two, whatever. It was too random for me, and so oops, I added this on the footprint. Sorry. So I needed another piece of the puzzle, and the thing I saw on the footprint over and over again was whenever these moves eventually fade, like when you look back and you study them, when they finally give up, it's not the first aggressive seller usually that causes it to fall. It's the first aggressive seller that comes in after all of the buyers came in, right? And we all learn to buy breakouts, or like early on you learn momentum trades, right? Like so you're like, okay, this is your resistance here, and so if you get a breakout over resistance, you can buy, otherwise buy the pullback and then hold on for dear life for the breakout, right? This is fine, right? You can still do that. That still works. But realize that these buyers here are not the buyers you want to be fighting. You don't want to fight these buyers. Like, not right away. They're not going to sell. They're not, well, they might sell, but they won't sell all of it, right? They may take a break like this, but it's not going to come all the way back here and take out this higher low very often. So you really don't want, even though you might say, oh, look, it's so overbought on whatever oscillator you're looking at, if you think it's balanced and or bearish and you're like, I want to short this, don't fight this volume, right? This impulse move should not be fought. That's really what I'm trying to say. Instead, wait for it to get up here. Don't even short it there, but when they try to make another high and they can't find the same level of buying, where they're getting more buyers, the auction's not turning around, but this whole area here is just like it's not as aggressive as the breakout was. And so that's the sign where we can start to look for shorts. And for me, this is the trigger, and then I'm getting the short, right? The exact same thing happens on the other side. So let me show you, even in a bear market. So because we're zoomed into a 24 tick, so you're gonna see it there too. Okay, so here's the move down. You can see hopefully now the impulse move is pretty clear. Impulse move down, right? Don't fight that, right? Don't buy this. Even if you have a great level here, and you've got like every reason in the world to think that it's not going to go much lower, like don't bother just putting a buy order here and buying it. Like wait for the signal, right? Whatever you decide it is. And like I said, for me, I need divergence, right? And then I need the aggressive signal, and I need risk reward. So for me, it was here. You'll see the green and the orange, which are inverse signals, are going to work really well with this setup. The stars and the diamonds will work too, but the green and the orange work better. So you can see that's the primary entry. And if there's a purple bar before it or a pink bar before the orange one, oh, there wasn't one here. If there's a pink right before the orange up there, it's even better. But orange and green are the way to go for my system. And then I'm getting it back to you. And again, remember, this is a mean reversion trade. We're not trying to pick the bottom, right? We're just identifying that all this setup is it's saying price went lower, but the sellers here were not as aggressive and committed as the sellers here, yet price is lower. So all I'm doing is I'm seeing that and I'm saying the right value for price is in there, where everyone agreed that it was a sell, yet price is down here. So I'm going to take it from here back up to here and get paid for that, because it's going to happen often. And that's all there is to it. And you might say like that's not that much meat on the bone, right? I'm only getting this here. That's all I'm getting, right? But keep in mind, with leverage futures, like even if you didn't get in until, like, let's say you had a level, like I had a level 11,687.50. Let's say I wanted to be cautious and I waited for that level on like a pullback here, and then I played it back up into this area and got out at like 11,715 or something. Like, you got to realize that's still 30 points on NQ. which is $20 for every point for every contract. So, that's a good chunk of change. I'm trading 2 contracts. That's potentially a $600 move right there. It doesn't look like much, but this little move right here pays the same amount as what I normally get paid at like my regular job that I went to graduate school for. You don't need to you don't need to be the buyer here, although that also I can show you how to get it. But that you don't have to buy this one and sell this one to make good money trading. You just need to have a system that repeats itself over and over again. So how would you get something like this? Well, I will show you. If you're using the volume zone oscillator and you've got some other ways to identify aggressive traders and pivots and stuff like that, such as using the TNP algo. Hold on real quick. I'm gonna make sure this is not an important text. No, we're good. What you can do is you can identify. There's another way to do this that might be a little bit easier to see. Basically, we're gonna look at this impulse move, right? And we're gonna identify the important zone down here where they got quote unquote oversold, right? They had so much selling down here. Oops, let me draw that a different way. They've got so much selling down here that and we don't really know that the price deserves to be this low, but yet we're getting only selling for like a long time, right? That's what this bottom oscillator is telling me. All selling for an extensive, not time, for an extensive range. It's only sellers for an extensive range. So we're gonna mark off the zone between wherever that low was on the oscillator, not on price, but on the oscillator, and then wherever the last buyer that existed before that, who tried to like save the level, which is this wick right here. If you want, you can zoom in to a smaller time frame and identify like aggressive signals or whatever you want to use for that. Like, is up to you. Like, I'm basically just using wicks, but if I've got a trading perform algo, I'll use that instead. But here I would use this wick. And so here's the pattern that I'm looking for here. Once that's put in, this is a very conservative way to trade. Okay, like let's say you don't want to be the first one. You don't want to take that first trade. That the idea of buying, well, this one didn't have risk reward, but the idea of buying this here is nerve wracking, and you don't like the idea of just like buying a new low, right? And maybe you don't have a real strong idea of how to find an aggressive signal on the footprint or the DOM, and you don't have the trade and perform algo, so you're like, I'm not just gonna. And I'd agree then. In that case, don't just buy this, because you're gonna get wrecked a lot, right? You need to be able to know that there's actually buyers there responding, and you want to follow those buyers in. So let's say you didn't have a way to get this. Well, what you can do is, like I said, if you mark off wherever that impulse move on the oscillator was, and then the point above them where the buyers actually fought back, which is this wick here or any star or anything like that, on the algo. Then you go to the right and you see if we can get above that with an entire Renko bar, what Simon calls a orthodox close. And so the low of the Renko bar needs to be above this Renko bar's high. So the bar has to be up here. That is your conservative sign that it may be time not only to look for scalps to the long side, but actually swings to the long side. So we wait. So it still hasn't happened. See how this, here, hold on. See how this wick is still inside the range of this one. So this is not yet what we call an orthodox close or a full close above. So we'd wait, and in the meantime, we're getting setups down here that if you have the algo, you can take. These purple bar, green bar setups or purple bar star setups work really well when there's divergence in either of these indicators. So yeah, you can get this simply by identifying that purple bar star, purple bar green bar, and purple bar star, purple bar diamond. That 2-bar combo to get back through this zone, and then you target the top of the zone. So you exit here, and you exit there. right? So those are scalps, but the swing comes after the orthodox close above. So there's your orthodox close above. This bar had no physical contact, no wick below, compared to this buyer. And keep in mind that the buyer who created this wick was stuck, right? Yet we're trading above him. What does that probably mean? It likely means there are shorts that got aggressive down here that are now trapped and offsides. Okay? So once you've gotten this, what you want to see, you don't just buy it. I mean, you could buy the breakout, but I don't. What I want now is a pullback into this zone where we had all of that sell volume into here, preferably near the low, but at least into where this started, right? And I want then to have an aggressive sign that buyers are responding to that zone. So here's what that, let me see if it sets up. It might, now if it does not give me an aggressive signal, I don't get long. So here it just went right, orthodox close above happened here, and they went right through it with no aggressive signal, so there's nothing to do. I don't lose any money, it's just, they didn't defend it, right? Now I can buy this because it's a little bit sketchy. There's no purple bar here, but you see how this one made a new low, right? So now we technically start the whole process over again. So you could buy this as a scalp, but now that this has made a new low, it's gotten under that red. Well, now we have to do it again. So now to get long, I need to, so this one did not set up. There's no losses, just no setup. So now I'm going to mark off, oops, I got to do it the other way, I forgot. I'm going to go the last buyer who fought back to the low. And I'm looking at this impulse move there. You can do the exact same thing on the opposite side, and if it breaks down, we will, I think it does actually, we can do that. So what are we looking for? After we find that, we want to orthodox close above. Happens right here, right? We get the low is above this high, right? This is the last buyer who tried to save it during all this selling. It's like the institutional buyer that got absorbed, and then they pushed through him, and then someone spiked back up. So even if you don't have a way to catch this, if you don't have the algo and you're not confident taking this, I wouldn't do it if you don't have a way to do it. If you can't see this star, like by looking at the DOM or looking at the footprint, don't just buy it, right? You need to know what aggression looks like on the DOM or on the footprint, or have an algo that's reading it for you. But once you can see the orthodox close without the algo. Now when it pulls back, now I'm looking in this same area, probably around 11,687.50, the voodoo range level, for an aggressive buyer to respond, and I will follow him in. So let's see if he shows up. He might not. He doesn't. Okay, they let it go all the way through, and they make a new low. And this made a new low. See that? Lower low. Guess what? We start over. Right? And so you can do this all day on both directions if you want. This is the low. This is the last guy who tried to fight, right? It's usually about 2 bars. Not always. Okay. We need an orthodox close above him, otherwise it's bearish. It's bearish. So you just don't buy there, right? There's no swing trade opportunity to the buy side. Let's try the other way. Let's try the other way. Oh, by the way, this little orange outline, the like above and below, it's a Sierra Chart's version of like a divergence detector. It's not very sophisticated. I don't love it, but it does help me remember to look at the indicators. So I don't use it just to buy, but you'll see that it works often as long as you get the signals, the pattern, the purple bar star, purple bar green bar, purple bar diamond is there. It'll be fine. But a lot of times it'll show up, like here it would work, but there's just there's a resistance in the way. But like here, for instance, there's no pattern to buy here. Yet they underline it because it's technically divergent, but it's not divergent the moment they get under this low. Well, then that comes back. So it's not perfect, but it does help me kind of remember to keep an eye on these indicators. So let's look at it the other way, right? We know that it eventually breaks down to the downside. So let's look at this from the short point of view, and we'll see if we would have gotten set up to the short side. So we'll back all the way up to where the impulse move started. Now, if we're looking at the opposite direction, we can see that we got quote unquote overbought scenario here, where we get a new high, everybody's buying, right? And there's no sellers responding right away. So we want to mark off wherever that ended, right? We wouldn't know where that is till it happened. It happened here, right? See how it's this high, and the guy, the last one to try to sell that before it broke higher was this wick here. Okay, like I said, it's usually around 2 bars behind it. It depends what they look like. But if they look like this with like a wick below it and a body above it, it's going to be 2 bars behind it usually. So then what we're looking for, like I said, the only way we can be bearish, if you don't have a way to identify aggression, right, and you can't catch this, even though you have divergence and aggression on the algo, I can see it. If you don't have that, and instead you want to, and you're not just looking for scalps or fades, you actually want to see when the, let's say you think the bigger picture is bearish and you want to know where the swing trade sets up, you need an orthodox close below this zone. Otherwise, it's going to be buyable on the bounces or sellable when we get under it and then reject it. So this would, if you were still bullish, you'd expect this to continue higher. It doesn't. Note they can't get an orthodox close below it without getting a response, so that's probably going to find a buyer. There's our orthodox close. The high of that purple bar is lower than the low of this wick. Right, so orthodox close below. We don't sell it yet. We wait for a retrace because we want to make sure that when price inevitably, well, not inevitably, usually price returns to that zone, and if it's bearish, we'll get a sign of aggression. So let's see. The aggressive thing to do is just to sell the breakdown. And sometimes with the downside, that's what you need to do. And here you might not actually get a chance to come back into it. They do not return to it. Okay. Sometimes that happens. We wait for the next overbought condition. This is close. It's not ideal. There. That's what we want. Above the green, right? Let's see if they reject. Okay, so they do. They reject this. So, oops. So this would be a sell. It's a sign of aggression upon return to that zone, rejecting the zone. Right? We identified the zone earlier as the point where all the buyers were impulsively entering, making a new high on the indicator, right? There, making a new high on the indicator right here, right? So we marked off that. They got under it. They came back. Buyers tried to break into it. They failed and rejected. That's the sell. Now, what's interesting about this one is they put in a new high. See that? Like this is a higher high on the indicator. So there's more impulsive buyers here, which means at this point, we can now draw another one. And if this one fails, we'd have another opportunity if that one gets a rejection. Only after an orthodox close. So there's our orthodox close below. So if we, now, like I said, we might have already been short here, but we could add on the trade if we pull back into that zone. I don't know if it does or not, right? Here. Now it's got to reject. There, so it rejects. See how it rejected off there? And there's your short, right? Even without the algo, you can do that. Now look, this one made another one, right? Another new high. Guess what? You can do it again. This one is close, whether or not it's this or this. It started getting overbought here, so I'm going to say, I'm calling it overbought, it's not. It's just overly aggressive, right? Orthodox close below happens here. Maybe it's the purple bar. Can't tell, there's too many levels here. We get under it. Oh, it just falls away. See, they tried to come back, and then they rejected it below, because there's a voodoo range level there. So nothing to do there unless they come all the way back to it and reject it. Right. There. Came to it, rejected it with aggression. These are sells, generally. Out of the area. First test back into the area, now you can sell it again. So you can see, like, it doesn't have to be stressful. Like, you don't need to just scalp every move. If you have a system, you could be very selective and you wouldn't get very many stops. So here, look, you got another high, right? So while you could take this one, doesn't invalidate this. It just means now if we get under this, we retrace back through it or into it and then reject, we can get another sell. So there's the orthodox close below, right? Now we need a rejection. Aggressive seller. And falls away, right? So whether or not you took that one or this one or this one, all those aggressive sellers got follow through. A little more, and you can see we've gotten under it here, right? So you could do it in reverse, but then they just make another low. So that same short is still active. I'm not marking these areas because this is not getting overbought, right? So I need to wait until it gets all the way back out. If I was looking for longs, I'd start marking off down here. Here, let's do a long. Let's do a long. We might have done this one already. This is the lowest it got. No, nothing crossed the red line, so this is clearly these 3 bars. We need an orthodox close above. The low needs to be higher than this high. It's close. It's close, but I don't think it is. I think it shares a low and a high. So orthodox close is there. That for sure is an orthodox close. So now any pullback that gets aggressively bought in that zone can be bought. Oh yeah, they got all the way under it. So that's aggressive to do it that way. You want to see it up here. Let's see if they can do it again. Orthodox close above. Okay, any pullback that gets bought can there. That's your buy. That's what they look like. Those are swing trades. See that? And when I say swing, I mean at least like 30 to 50 points on NQ, at least 10 points on ES. You'll get not just like a little scalp, like you'll get an entire, like you might even get a higher low and more, right? It could go 50. In this scenario, you're fighting the bigger trend, so it didn't go that far. But here's another high, right? So you could literally do this all day. Right here. Orthodox close below happens here. They don't quite reach where I drew to. Now, if you extend this just a little bit further and you say that this guy or this guy was your last seller, and to be fair, this one kind of does look like your last seller because it came up to that, then you get this guy, right? So it just, but then do you get an orthodox close? No. An orthodox close below this one. So yeah, sometimes it just doesn't set up. And that's the problem with being conservative. You're not going to get a lot of stops, but you're going to miss a lot of these because you didn't take the aggressive trade. But look what happens when it gets down here. This is what I like about it, is that you don't get crushed. So look, this is the low, right? Here's the last buyer. Right? That's where all the selling was. And then this is capitulation. So if we can get an orthodox close above this, any pullback that gets bought can get follow through. So orthodox closes right there. No, the low is higher than this high, where all the buyer, where that last buyer that got absorbed was. We're now above him. Any pullback that gets bought in the zone can get. Okay, so I don't usually buy these green ones, but that could have been a stop potentially. Right, that looked like if it would have been a star, I would have said it would be good to go, or green on the inside, or a diamond. It didn't have enough conditions. The green on its own, like that, is not usually good enough for me to take. But technically, I think that's the first stop I've seen with that process. Here you had the high way back here, right? So this is where most of the buyers was back in this area. The impulsive buyers happened here. That. You got an orthodox close below it. Again, now we're looking at buyers, so we need orthodox close below it. Happened. Doesn't happen. They save it. See that? They save it. And that's where the green bars are good, I guess, is at lows. Not so much for like higher lows, but they're trap signals is what the green outline is. So you want to actually have a seller here to trap. Up here, it's like, I don't want to know that I trap somebody. I want to know that there's a buyer that's aggressively defending it. And so this is a seller's trap, but I don't really have any aggressive buyers. But like I said, this ends up pushing. And then do we get a set up here? That should be under this for a short, or else over inside here for a long. I don't think it sets up. Yeah, it just chops around in here. Look at that. So it's just bullshit price action. Like nobody's participating, right? Like they're just stuck in this zone. So what I would need to happen is for to get a trade here. Oh, we got a new. Did we get a new low on the oscillator? Yeah, I'd say we did. So to get a high, to get a buy, it'd be like this. I need to get an orthodox close above that high, which is here. And then we need to pull back and get a buyer to defend it. So that actually would have happened right there. So you could, if you thought this was potentially bullish, this did set up. So we'll have to see if that goes higher. The problem is your high is up here. The reason why this is stuck, you guys, is because the high is so close to the low. Look, there's aggressive buyers that came in right here. So the sell setup already triggered. We got orthodox calls below, came up. These are sells. So you have the sells like running into the buys, and that's why you get this chop, 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 chop. One of these, eventually this is obviously going to break, and wherever it goes, it's going to be an explosive move because the high on the oscillator and the low on the oscillator happened in one wave. So whenever you have one rotation like this that makes a new high and a new low, the next move is a bigger move. After this consolidation breaks, that next move is going to be expansionary, right? It's expandatory. It's going to expand the range. So we'll get like some kind of a breakout or a breakdown. And like I said, the locations that need to hold, or that we've already gotten in both cases, the orthodox close above and below, which is weird. That's why we're getting this, is that they're both valid. But the short set up first, and then before it went anywhere, the long set up. So I don't really know what to do with that other than just to wait till we leave the area. But whenever I see this big wave, it's a higher low on price and a lower low on the indicator. See that? This is a higher low than this one, but this is a lower low than this one, I believe. I've seen that happen before, and when it does, it leads to consolidation followed by a big explosion in price range. And what is the current trend? Down, right? Trend down, higher low. This is probably going lower. It paused for a minute, made a higher low. Buyers are going to try to break it. They won't be able to overcome this high, and it'll roll over. That's what I would guess would happen, is continuation. Because if you think about it, for this to get an impulse move, remember the oscillator rarely spends a lot of time below or above the green area, right? And so here we're in the middle. This is just like, I didn't even look at it. Like I said, I don't even care what it does in here. But notice that it's already approaching this lower end, right? And it's still in the middle of this chop. And so if we got a low lower than this, it's an impulse move down. And if we got, but there's not a lot of space down there, so it probably wouldn't last, right? So which is strange because it should be range expansion. So maybe that suggests that it's not going lower. I'm not sure about that part. The one thing I do see is that it looks like there's a lot more space to move up to the top than there is to the bottom. That's kind of interesting. Let's see if we can find another one of these quick where they had the high and the low in one wave. I know I've seen it before. Let me see how it resolved. Here, is this one? Nope, that's a higher low. I've seen this before. It's just rare. Nope. Right here. Right. No. Because this is the low. It made a divergent. Well, that's like almost like a head and shoulders kind of setup, right? Where you get divergent. This is perfect for the long, where you get to the divergent lows, and then they just run out of sellers. See that? Okay, here we go. Higher low on price, lower low on the indicator, right? Then they make a higher high on the indicator and a lower high on price. What happens next? All the way down, new lower low, right? So one of these gets broken next, And it looks like it's the one that's furthest away from this last peak. So hold on. So in that case, it would be higher, right? Oops. I believe in that case, that would mean if that pattern is consistent, I don't know if it is, that would suggest that this resolves higher. So probably a divergent low. So we might get a lower low on price, but a higher low on the indicator, and then higher. That might make sense. Something like that. Anyway, that's the new idea I've been playing with, is kind of putting together the idea of divergence. And then you can use, like I said, you can use the MACD for divergence as well, and it actually is a little bit more consistent. If all you're looking at it is for filtering out entries that you don't want to take, and you basically only take the entries, you're only fading when there's divergence, you're going to do a lot better. So like here, higher low, lower low, right? This is lower, this is higher. If you have an entry here and a location, it's probably a good place to go to get long, and you'll get a nice little scalp, right? Just make sure that everyone sees that. But notice sometimes it's not like you need a divergent high for it to fall. It can just peak out, right? And that's where having another way to find this is helpful. So like knowing that if we came back in here after trading below it, if we come back into it, you can sell it. That's helpful for me. Having that flexibility for when there is no divergence. Like I might miss the scalp, right? Because there's no divergence, but I still have the opportunity for that breakdown or breakout and then retest for the swing trade. So yeah, these are some new ideas. Hope you guys learned something. If you got questions, you can always DM me on Twitter, or else I'll obviously comment here. Thanks for